if the debt ceiling is not raised, what kind of probability are we putting on the US AAA rating being cut? 60, 70, 80%?
Well, first of all, we do expect the debt ceiling to be raised. We're anticipating another last-minute deal, which probably won't address all the difficult decisions on tax and spending. If for any reason they weren't to come to any agreement, then we've made it clear we think that the US Treasury will effectively run out of cash towards the end of February, beginning of March. They're at the moment going through using these extraordinary measures, about 200 billion, that has given them a bit of leeway through the first couple of months of this year. But clearly they could then be into a very difficult position of having to prioritise between debt obligation repayments and other costs, paying bills, exactly.
But you also say in your report today that the US faces a downgrade later in the year, even if the debt ceiling crisis is averted.
Well, we're saying that still would be a possibility, because one of the key aspects of any agreement on the debt ceiling would be some kind of more far-reaching agreement between amongst Congress to address the longer-term sort of fiscal challenge that the US faces and place US finances on a sustainable medium-term path. It's the kind of issue that has been recurring since the last debt ceiling crisis in August 2011, something they haven't addressed up to now, and we're hoping that they are able to do so at this juncture.
So a last-minute deal in the next few weeks really won't do it for you?
Well, I think if it's a last-minute deal that is very comprehensive and addresses the sort of medium-term challenge of fiscal consolidation, then we'd have to take that aspect into consideration when we were assessing what we do with the rating and the current negative outlook. But I think a last-minute patch of the sort that they agreed on the fiscal cliff in January probably would be insufficient for us to maintain the AAA rating.